Hello again, John Flynn from Flynn Real Estate, serving Southern Ontario, based out of the Niagara region. Thanks all once again for tuning in and watching. This week, I'm going to bring you the stats from across the country for June. At the end of the video, I'm going to talk about my home buyer recipe. I've talked about it before, but I just wanted to give you an update. I posted it on my Twitter this week with kind of the key indicators that you should be looking at for when I think you should jump into the market or when the opportunities are. But first, I want to start about how we got here and kind of where we are. And of course, if you're wondering where we are, well, obviously, most people know where we are. We're at a point that we have high interest rates, unaffordable housing, and kind of a lot of people that have purchased into the high price market, a lot of people that are still waiting. But regardless, we can say that housing, whether you're renting or buying, is very unaffordable. And it's due to, of course, speculation in the past and with a combination of high interest rates now that make it even worse. So how did we actually get here? Well, this is my opinion, of course, but my opinion is based on my experiences and, of course, a lot of data that I've looked at over the last year and a half. But we got here from a low interest rate environment. And this was before COVID. COVID was just kind of the icing on the cake for many that really drove prices exponentially higher. But before that, we had an unsustainable run up in prices, and it was due to low interest rates. And it was fueled or contributed to by over speculation or over investment in housing. Of course, people were using their home equity lines of credit to put down payments on other homes. They were and then of course during COVID or even before, we had these fixed payment variable rate mortgages, so people would buy in knowing that they didn't have to worry about their prices or their payment changing, their mortgage payment changing. So we really had this perfect storm looking back to create this excess demand. And again, a lot of it was due to speculators and investors. Real estate actually became easier to speculate on than almost anything else in the country. And I compare it in the thumbnail to the toilet paper issue. When COVID first started, people were, running in and buying up all the toilet paper for whatever reason. I guess they worried about toilet paper during a pandemic. And same went for sanitizer and masks and all these things. And it was because people knew there was going to be demand for it. They didn't want to be left without. And some people were doing it to speculate and to sell them off. People were trying to sell them or actually did sell them on Amazon and other places, Kijiji, for 3-4 times what they paid. And at the end of the day, if you remember the grocery stores and the stores, they put a limit on how much of these products you could buy, 2 per person or whatever the case may be. So they kind of fixed that problem pretty easily with reducing the demand with a limit. And of course, that problem went away pretty quickly. Even though the pandemic didn't go away, the problem went away, and we had more than enough for everybody. Unfortunately, for real estate, one of the most needed assets or needed products in Canada, there was no limit put on anything. It was a free-for-all, and it was enabled. People were enabled to buy it, and the market psychology made it so that it became this ultra hot and somewhat rare asset that if you didn't buy it now, you would never get it. So we have this psychology that says, okay, real estate will never go down. We have all these immigrants coming in. And mind you, immigration wasn't a problem prior to the pandemic or even in the last few years until recently it became an issue. But that's going to be an issue going forward, not an issue in the past. So we're left with this psychology where people are fearful that of not being able to get into the market. And also the people who have purchased are still high on their horse thinking, I can make all this money. It's the most money I've ever made. It's a great get rich quick scheme, a real one that worked. And they didn't really need any money to get into it. They just took some equity out of their inflated property. And then, of course, they bought real estate. So it's going to take some time for this psychology to change so that people realize that, hey, real estate isn't a get rich quick scheme. It isn't a speculative asset and so forth. But I compare it to an abusive relationship. And I don't like to use this analogy because, this is a legitimate thing that happens to people, but it is. We've seen last year, people saw what happened to the market, all these bidding wars in 2022. And of course it went away and everything was better. It's like the abuse has stopped. And then this year it came back and it was like, okay, this is happening again. I knew this was too good to be true. So again, it takes time for this psychology and this sentiment, the market sentiment, to change, but it is changing. And I think that in the next couple of years, year to two, we're really going to see it change back to normal, where real estate isn't the get rich quick scheme. People are not going to be waiting for interest rates to drop, thinking everyone's going to jump back in at the same time. People will proceed with caution when it comes to real estate, seeing that what's happened and what's going to happen, right? With these asset prices that are going to drop, interest rates are still just taking hold, and we're going to see the market change. So I think that if you're a buyer, hang in there. If you're a seller and you haven't been too greedy, good for you. But expect that market psychology and sentiment to change over the next 2 years or so. Okay, now let's get into the stats from across the country. These things take a lot of time to get together and put it all in one, because all the different boards have different ways of reporting, and I have to look through them and whatever. And then certain boards don't report at certain times. But anyway, I have what I have. For those of you that don't see your area or region on here, it's because they hadn't reported them yet. And of course, this is the 10th of July when I'm recording this video. So looking at the month-over-month price changes from May to June, and this is Ontario. I do Canada on a separate chart. So you can see the biggest losses here are from Woodstock, Ingersoll, Windsor, Essex, Brantford, Toronto. Actually, Toronto was down 2.8% in June from May. Pretty big decline from Toronto. They almost hit their peak pricing, actually, or their market highs, which would have been in February 2022, and they were just 4% off that all-time high, but they lost again another 2.8% last month. Lakelands, Muskoka, they're down. Bancroft down. North Bay's down. Peel, Brampton, and Mississauga, they were down 1.5%, 2% or so. Kitchener, Waterloo, down a little bit. Same with London, St. Thomas, Ottawa, Grey Bruce, Owen Sound. York, pretty even, maybe up 0.5% or so. And of course, we go through the rest, all into positive territory month over month. I don't think they got the news flash yet that the market has changed and the interest rates went up. And the biggest month over month gains were in Cambridge, and they were around 7% month over month. And in the rest of Canada, biggest declines were just around 5% in Victoria, BC. Nova Scotia down 3.5% or so. Greater Vancouver down 3.1%. So they were just 1% or 1.3% off their all-time highs in May. And of course, in June, they went down 3.1%. So they didn't quite make it to their all-time highs. Edmonton, they're down just over 2%. Montreal down. Quebec down. PEI down, and of course the rest here. Calgary is almost even. Saskatchewan up 1% or so. Same with Fraser Valley. Vancouver Island just under 2%. In northern BC about 3% or so. Now on to the percent change from the peak. In Ontario, everywhere is still negative from peak pricing, with Woodstock and Ingersoll over 20%. The only place, Brantford is also over 20%. So 2 places over 20%. The rest of them are really creeping back up quickly to that 20% club, I call it. And you can see, go down through the list there. Faring the best is the city of Toronto, with about 7% losses from the peak. Again, they were at 4% the month before. So they are faring the best, which is expected, being a big city. Other places like York, Muskoka have done pretty well too. Ottawa's not too bad either, about 12% or so down. For the rest of the country, Fraser Valley has still seen the biggest losses, with about 14% from the peak. Victoria, 12% from the peak. Then Vancouver Island, just under 10%. PEI, around 9%. Greater Vancouver, less than 5%, and the rest, Nova Scotia, Montreal, Quebec, Northern BC, Edmonton, all less than 5%, with Calgary and Saskatchewan just above their all-time highs, but pretty much at their all-time highs. And for dollar losses or dollar changes from the peak, they're all losses in Ontario. Oakville, almost, 240,000 or so from the peak they're down. Durham region, Southern Georgian Bay, Peel, Woodstock, Ingersoll. That's a big one for Woodstock, because they're not a high price point compared to, say, Peel or Durham or somewhere like that. So having them down over that's a pretty big percentage, actually, as we saw on the other chart. Brantford goes down the list. Lots of places. It seems to be about 150,000 would be the average. And you get to Huron, Perth, and Toronto are doing the best. Ottawa is actually less than 100,000 also, and same with Kingston in the area. And for the rest of the country, Fraser Valley, about 175 to 180,000 they're down. Victoria, 125,000. Vancouver Island, just under 100. Greater Vancouver area, about 58,000 if my memory serves me correctly. And the rest are all less than 50,000. PEI, Montreal, Nova Scotia, province of Quebec, Northern BC, Edmonton. And again, Calgary and Saskatchewan, not much change from the peak. On to inventory or new listings. This is just new listings. As you can see, most places are still down for new listings, not as aggressively as they were in, say, a couple months ago. They were 50, 60% some places. Now we're not even 30% compared with last June. And some places even showing more listings than they were last year. Places like York, Peterborough, Kawarthas, Northumberland, Georgian Bay, and the rest. Same trend for the rest of Canada. Most places are seeing fewer listings than they were last June. Nova Scotia leading the way, Montreal, province of Quebec, etc., and PEI, Fraser Valley, and Greater Vancouver all showing more new listings than last June. And now on to the sales. Almost all areas besides the four at the top, Kingston, North Bay, Windsor, Essex, and Durham region, are showing more sales than they did last June. Last June, we were in free fall for sales, so that's not unexpected. So sales are up, but new listings are still down. And for the rest of the country, it's 50-50. Some places are showing increased sales, some places are not. You can see Nova Scotia, Montreal, Northern BC, province of Quebec, Saskatchewan, Edmonton are showing less sales than June 2022. And Vancouver Island, PEI, Vancouver Island, Calgary, Victoria, Greater Vancouver, and Fraser Valley are all showing a lot more sales. Actually, Fraser Valley is showing 50% more sales than they did last June, which is pretty intense. Okay, so that's it for the stats from across the country. I guess you could say we have a mixed bag. I think prices, the national price will most likely be flat for June. We might see a little bit up or down, but it's going to be pretty flat. And I think we know which direction we're going from here on in. Now I want to get into my home buyer recipe. This was all based off of research. I did this last year and I looked at the trends and compared them with the prices and when was the best time to buy or buying opportunities. This is not the bottom of the market. I'm not calling the bottom. This is just when historically is a good time to buy. And there's 4 criteria here. This is from my Twitter post. Check it out. Interest rates need to start dropping. Unemployment rates need to spike. Mortgage arrears need to spike, or defaults, I guess. And home prices need to be in a downward trend, obviously. So there's this misconception that when interest rates start going down, the market's going to take back off again. And that's not what happens. That's actually probably the number one indicator. When interest rates start dropping, it's because the market's in trouble and things will be in a downward spiral or trend. And that takes time for those interest rates to take effect, even at that point. So when they start reversing, it'll take time for prices to rebound. So usually actually always when interest rates start dropping, it's because the real estate market's in trouble or the markets are in trouble. And we're going to see losses at that point. It doesn't automatically turn around like it did recently when they announced something. That's speculation. That's not reality. Look out for those interest rates to start dropping. I don't think it's going to be this year. It's going to be next year, maybe later, but look for that trend. Next would be unemployment rate spikes. So we did see a little uptick this month in unemployment. It went to 5.4%. Of course, that's not a spike, but it is trending up. I think it was around 5% at the lowest at one point last year. And anyway, it is trending up. It went 0.2% in 1 month. Keep watching for that unemployment to spike because it is obviously a major indicator when it comes to house prices. And of course, mortgage arrears haven't spiked. They're not at their ultra lows, but they're still pretty low, but we'll watch those. They're going to start trending up. Of course, mortgage arrears will come before defaults, but you can watch for defaults also. And lastly, home prices need to be trending down. Of course, they trended down before the beginning of this year, and a lot of people maybe thought it was a good opportunity, or they did think it was a good opportunity to jump in, but we didn't have the other indicators. And of course, now you're going to see that they went up in the spring, but you're going to start to see them trend down again. So they're a little too early, in my opinion, the people that jumped in that were waiting for the opportunity. Some people, they don't need to wait or didn't want to wait for the great opportunity. They just wanted a break in the action to get into the market. But a lot of the people in the spring just bought because they thought, okay, this is my chance. Prices are going to go up again. I want to get in. So almost a FOMO reason for jumping in, not based off of stats or data or indicators, in my opinion, but watch for all these 4 indicators. When they line up, it's a great time to buy. So that's it for this week. Thanks for watching, and I'll see you next time.